Welcome back, dear investors, dear subscribers, and probably if you're here, you're interested in knowing one thing: making money by trading in stock. But where do you start, and which method can really work for you? In this video, we are going to explain 3 methods that you can use to apply if you want to trade in stock. One of them is speculative investment. The second one is buying share for dividends purposes or long-term investment, and the last one is using founder member method of acquiring shares that you can use to earn money or to create wealth within yourself. At the end of this video, you'll have a clear understanding on which method can really work for you and how you can apply it, or if you want to venture into stock market, which method will really work best for you. Let's begin with founder share venture. This is a very high profitable method that you can use to venture into acquiring shares in companies that are starting up and the companies that have not placed their shares in initial public offer or in the stock market. So if you decide to buy shares early in these companies, you can get advantage of growing the value of your shares, and especially when they are introduced to the stock market through IPO, you'll be able to have a split of your share, and the value of your share can grow significantly, and that one can really make you rich. So founder shares are equity given to shareholders at early stage when the companies are starting up. You should also know that there's no guarantee that companies that are starting up, they can really do well. So you need to be very careful in this company that are starting up, so that you know where you can place your money when you are buying these founder shares. There's a friend of mine whom there's a time they were retrenched. There's a season where retrenchment was happening in my country, and this person was retrenched and was given some golden handshake. So he decided to buy founder shares of a certain financial institution, and when this company went to offer their share in the stock market, that is the initial public offer, this person really gained because he was able to sell part of his shares, that 10%. He was able to buy a vehicle, he bought a land somewhere and constructed a house. The remaining 90% now is able to collect a dividends of worth 450,000 Kenya shillings net every year. And if you look at that, that's a good income that somebody can get as a dividend. So it means if you are able to get an opportunity to venture in these startup companies or companies that are just growing and they have not found themselves in the stock market, you'll be able to have that an opportunity that your shares can really grow, because normally these shares are normally cheaper. You'll find that they're normally cheaper when you're buying them before they are floated in the stock market, if they're offering that shares in the market. There's also another friend of mine whom also ventured into another company, a financial institution still. He was able to just pay 100,000 Kenya shillings, and that company, I know it has not gone to the stock market, and I know when that company will go there, he'll be able to make good money. The strategy here is that when you are buying shares as a founder member, chances of you getting more shares, or the chances of your shares growing in value when they are being offered in the Nairobi stock market or any stock market, it will be high, because these shares, they'll be splitted. Let's say when you value of the shares you bought as a founder member was 10 Kenya shillings, and maybe when that company decided to offer those shares in the stock market, the value of your share will be splitted, and then they'll be given a price that is going to be sold in the stock market. You'll find that if it was 10 shillings as a founder member, maybe if it is splitted and offered in the stock market, you can even get a value of maybe a million or 100,000. So if you sell those shares at that particular time, you can make a lot of money. Or if you just sell part of it, or maybe if you just leave it, you'll get a better chance of earning good dividends at the end of the day. The idea of being a founder member is that you are just investing in the potential of a company to grow, so that if the company grows, you also grow your share value also grow in that company. So if you are able to distinguish a company that can grow with you, so that by the time it is being introduced to stock market, or if the time they are offering their shares in the initial public offer, you will get that opportunity to reap and grow financially. Remember also, it is not guaranteed that all startup companies succeed. So you should be able to get financial advices from good financial advisors, so that you can know where to invest your money wisely. But it is better if you can get an opportunity to get founder share, because that is you have an automatic growth if that company grows, or if that company does well, and eventually if their shares are introduced in the Nairobi stock market or any stock market in your country. Let's just take an example of a company like Facebook. When it started, maybe so many people didn't think it can pick up. And if you had an opportunity, or those investors who bought shares as founder member in Facebook, or the person who founded that company, because the moment you found a company, limited company, whether you are one person or two, you are founder members. So the moment that company does well and is taken to the Nairobi stock or any stock market, it means you are going to reap. I know that the Safaricom shareholders who were there before the Safaricom was placed in Nairobi stock market, they really made money. An example also I can give you, when Kengen was being introduced to the stock market, the price that was being given for one share was around 11 bob, and maybe the value of that share for founder member, maybe it was even 50 cents. So you see, somebody is making almost 10 shillings and 50 cents per share if you sell those shares at that initial public offer. But if you leave them, your share will start growing from that 11 bob going upward. The second strategy is speculative investment, and this method only capitalizes on the movement of price of shares upward or downward. So the speculators, they look at the way shares of all companies that are in the stock market are behaving. Like, for example, if they know price of company A is going to come down, they hold their money and buy those shares. The moment that price of that company goes up, they sell. And they normally target small range or different range of profit. For example, if a share is being sold at 10 bob in the stock market, and if there is just a small margin going upward, like 50 cents or 1 shillings, they'll be able to sell their shares. Or if they are looking at that shares, if the price goes down even with 1 bob or 2 bob, they'll buy. And also, and that is all about speculating, because you are just looking at which type of shares are going down, and when they are going down, that's the moment you are buying. When they are going up, that is the moment you are selling. And speculators, normally they trade in big amount of capital, because if you buy, let's say for example 100 to maybe 500, the profit you are going to make will not be even enough for you to cater for the charges fee that a broker is going to charge you. So if you want to be a good speculator, you need to trade with good amount of money, and you need also to have information how the market is behaving. And the market can behave very funny. Like during election, normally investors offload their shares in the stock market. They normally fear, so most of them usually sell their shares, and then maybe after that they come back and buy. So the moment people are selling more shares, that the price of those shares goes down. So a good speculator can buy shares at that time, and when the economy is doing well, or when there's a goodwill in the country, the shares of those price goes up, and that is the time the speculators sell their shares. Imagine, for example, if this investor has just bought a share at 10 bob, and maybe after 2 days they sold that share they bought at 10 bob at maybe 11 bob, and maybe they invested like a million shares. So it means it is 1 million times 1 million. So the profit this person is going to make here is 1 million. So within 1 day or within 2 days, this person is able to make 1 million, or within hours. Some investors even sell within hours and buy within hours. So speculators, they are always there in the stock market to know how the market is trending, and they capitalize on how it is trending. So those people who fear losing money, or those people who fear that what they invested can be lost, this is not the right method that you can use. Those people who are risk takers, or those who are ready to lose what they invested, because maybe you can buy a share at 10 bob, thinking that it can rise maybe to 12 to 13, and something happens that the share of that the price of that share drops maybe even to 2 bob or 5 bob. You're going to lose a lot of money there. So if you decide to be a speculator, you should be able and ready to lose your investment at any time, or you should be ready to make more money at any time. The key thing about speculating is timing, because these investors, they are not bothered on holding those stock or the dividends that are going to be paid. What matters to them is how the shares are behaving in the market. So what matters in speculation is timing. You should be a good timer, and you should have information about the market that you are trading in at your fingertip. But you will be able to communicate with your broker each and every time of your trading. Now let's talk about slow and steady approach of investing, and that is long-term investing or dividend investing. This is the perfect method that you can use, or those people who are not constantly watching at the way the market is behaving. This is the best method that they can use to invest, because they'll just buy shares and leave it for a long time, or just wait for dividends payment and make money. Long-term investing is all about holding stock in stable companies for years or even for decades, and purposely to earn dividends, and also to wait for the growth of your share value in the company that you've invested. So this is the best strategy for the beginners, or those people who cannot follow the trend of the market. They can just buy those shares and leave it there or forget about them, and annually they'll be receiving dividends, or semi-annually, depending how the company has performed. It's also another method that those small investors, those who are starting to venture into trading in stock, can start. You can start by buying 1 share, or 100 share, 500 share, 200 share, or adding up. And you can also have an opportunity of buying shares of different accounts or different companies, and at the end of the day, you'll be able to collectively have a portfolio that you can get a good value of your money that you've invested, or you'll be able to get dividends from each and every company that you've invested at the end of the year. So if you are thinking to start investing in stock market, this is the best method you can start for, because you can just look for a stable company, a company that you've known as a good history of paying dividends, or their shares has been growing, and then you buy their shares as much as you can every time that you have money, and you'll be able to have a good stock that you can hold as an asset for yourself. Another key component that you need also to consider when you're applying this method of investing is in stock market is the dividends element, because you realize that at the end of the day, for those companies that are doing well, you will be able to have an income every year or semi-annually, and once the dividends are declared, you'll be able to create wealth. As you create wealth and earn your dividends, the value of your shares also will be growing. For example, if the company that you invested in has just decided to split their shares, and this split normally comes when the price of the shares of the company has reached in a level that maybe it cannot trade further. For example, if a company price per share in stock market is like 300, one share is 300 shillings. The company or the shareholders can decide to split those shares. Also, one share can be splitted into maybe 30 shares or 100 shares. At the end of the day, you'll be able to have grown the number of shares that you have. And once that share has started trading the stock market, the value of your share will rise, it will skyrocket. It will just behave as that one that I explained in the first option, that if you're a founder member the moment that your company has decided to trade in the stock market, once they've placed their shares in the stock market, you'll be able to gain, because normally those shares are usually splitted into a smaller value that can be bought in by public in the stock market. Areas, if you are taking this method as your way of investing, you can decide to choose from different classes of sectors. Like maybe if you have 2 companies in financial sector, you buy shares in and other 3 companies in insurance sectors, other company in industrial sector, so that if there is something that maybe one sector is not performing in that year, you'll be able to have earned commission in different sectors. So the best thing you can do here, if you're a long-term investor, look for several companies. Just have a portfolio of shares from different companies, and target those companies that are strong, or the companies you know can really grow. You can really grow in terms of earning dividends, and in terms of maybe the price of shares growing and making the value of your shares good, that you can also have a good asset. You know, the shares are a good asset that you can even use them to get a loan. You can use them as collateral somewhere. You can even use them in court to get for somebody bonds. So the moment you decide to invest in shares, know that you are building wealth for yourself, for your generation, or maybe for your children. So dear investor, dear subscribers, I know you are able to distinguish the best strategy you can use when you are venturing into stock market trading, and that is speculative method of trading. Or maybe if you decide to get your shares in the founder companies, or you join those companies that they have not placed their offer in the stock market, or you just want to be a long-term investor or just earn dividends, I know you are able to distinguish the best method you can apply and the strategy you can use to earn money in the stock market. In our next class, you're going to learn how you can start trading in the stock market, because you know you cannot just go and buy shares anyhowly without following the procedure that are required. Remember, there are brokers in this market. We are going to learn how you can go about it. So keep it here. If you not join our class, as a subscriber, subscribe so that you get our next class in time. Remember also to share this video to your friends, those you think maybe may want to start trading in the stock market. Thank you, and see you in our next class.